Hey everybody, Brian Shannon here from alphatrends.net. It's Wednesday, the 18th of September, and we had a very choppy afternoon after the Federal Reserve cut interest rates by 50 basis points. The expectation, I think, from most traders was a choppy afternoon, and that's exactly what they got. As far as whether you predicted 25 basis points, 50 basis points, nobody cares. What matters is what's going on with the market. Let's take a look at this chart again just to create that simplistic look that people seem to like a lot. And that is the SPY right here is right now still holding at the rising 5-day moving average. Key support in here is at about 559.5. NASDAQ holds its anchor from last week's reversal and the top end of this support, which is at about 469.5. Semis are a little bit more reason for caution in here. They are at the bottom end of this range and in danger of breaking down to maybe go test the anchor off of the recent low. And the biotechs were pretty squirrely here. We'll talk about those in a minute. Let's go to, as we do, look at two different time frames. And, yesterday we saw the S&P 500 hit a new all-time high and then quickly reverse. This afternoon we made a higher high and then come back into the range once again. I had put this out on Twitter basically for this quote right here. Complacency is a silent enemy. If you are complacent up here, you shouldn't be. Be aware that the market is saying it's trying to break to new all-time highs, but it's gotten stuffed 2 days in a row. Now, it hasn't done any technical damage to the market, but it definitely gives us a reason to recognize that there is a bright, flashing yellow light saying caution. Caution doesn't mean sell. Caution doesn't mean sell short. It means be cautious here. Look at the positives. We still have a rising 5-day moving average. That 5-day moving average will rise tomorrow as we get rid of this data, unless we decline below that level. We're still above the anchor off of this recent low. We're still above the month-to-date anchored VWAP. So the key level, I think, is 560. If we break below it, not a big deal, but if we break below it and then stay below it and see that that turns to supply, in other words, resistance, then perhaps we see a little bit deeper pullback down to the anchor for the month to date. If that fails to hold, then we have a 20-day moving average. We have a 50-day moving average and an anchor off of the August 5th low. Now, the bigger picture, the daily time frame still says bullish but cautious. So that's what you need to recognize, and recognize that it means initiating new longer term positions probably isn't the time quite yet, and that you need to just be a little bit more patient in here. We have a declining 20 and 50-day moving average in the NASDAQ. The market is above both of those. What's more important to me is the direction of those moving averages and where those moving averages are likely to be in the next few days. This is where we were 50 days ago. That's what this vertical line here is. So in the next week, we get rid of this data, meaning that 50-day moving average will continue to decline. The 20-day moving average, we get rid of this data. That will continue to decline unless we're way up here. So on the NASDAQ, the key level in here is at about 469.5, as we mentioned. If we break below, not a big deal, but if we break below and then hold below and find, let's say, supply that looks something like this, we get trapped below the 5-day moving average, then see something like this happens, then I think it's highly likely we test the month to date, highly likely we test the anchor from this low, and then we'll take it each step as it occurs. I'm a swing trader. I'm not interested in where it's going to be December 31st of this year. I'm not interested in where it will be December 31st of 2025. What matters is the days in between and making good trades in there and managing risk. Meanwhile, we did make a little higher high in here today, 2 days in a row where it's got stuff back in as well. Those are reasons to be cautious. The Russell 2000 has been quite strong. As you know, I've been saying I have no interest in this market. It's just too choppy. I've also been telling people that if you are long, just raise your stop up. Know where your stop goes. Complacency is the silent enemy of your equity. If you're complacent and you don't, like the people who were complacent over here, they had all this happen. You can say, well, we're right back. We were, but we dropped, this much once. We dropped this much twice. That is too much pain, certainly for me to hold through. I would hate to buy up here and just be breaking even and having these crushing declines. So to me, I think that the Russell 2000 continues to be something to avoid if it's something that's more attractive to you. raise your stop up underneath the most recent relevant high or low for your time frame concepts I talk about in my anchored volume weighted average price book. The semiconductors are giving a little bit more reason for caution. These guys also have a declining 20-day moving average. This is where we were 20 days ago, so that's that red 20-day moving average. This is where we were 50 days ago. That's the blue declining 50-day moving average. On the bright note, we're holding above the anchor from the August 5th low. We're also above the month-to-date anchor. We're also above the anchor from this low. So we're down at the bottom end of this range right in here. Let's just erase all that. And here we can just draw it in again so we can see it a little bit more clearly. What do we have here? We had a failed break higher and a fast move lower. Same thing. If we get trapped below that 5-day moving average and it starts to decline, then I think you have to be on the lookout for at least another test of the year-to-date anchor, maybe the 200-day moving average. Take it each step at a time. It's truly, one piece of the puzzle each day. For the biotechs, as you know, I was talking about it very heavily over here, got long, actually on this day at 98.55, I think it was. Yesterday, I sold a third at 101.80. Today, I sold another third as it broke this low right here. So looking at the 5-minute time frame, these are things I talk about in Discord for Alpha Trend subscribers. Below this low right here, I sold another third. So I have 1/3 left. I'm still bullish on this group. I still think it's inevitable that they break beyond here, but I'm also a trader. I know my time frame. When I buy at 98.55, and if I were not to sell some and it comes all the way back down to where I was, where I got filled, I'm not going to feel like like I did something good for breaking even, and I certainly wouldn't take a loss. Instead, I'm happy to have a 1/3 position. If it breaks out and continues to run, great. I'll make money on that first third. But if it declines, I'm probably going to sell it, under here tomorrow, and then I can reposition, because if it breaks down, and maybe, who knows, maybe it does this. I don't have a crystal ball. But I'd rather see it do this and then be a buyer right here and look for a breakout again. You have to listen to the message of the market for your time frame. Sound familiar? Financial stocks, I continue to avoid them. They gapped up this week. They're holding the week-to-date volume-weighted average price. So they're still showing relative strength with a rising 20 and 50-day moving average, rising 200-day moving average. Complacency is a silent enemy. Just know where your stop is if you're long. The energy names, they're right up into a zone where it seems like they should find supply. So you have to look at it and say, we still have a pattern here of lower highs and lower lows. That has not changed. This looks like a lower high. It certainly looks like a place where it's likely to find supply. We've got the year-to-date anchor there. We've got the 50-day moving average there. We've got the 200-day moving average there. And is it time to get bullish when we have declining moving averages and we have a big rally up into a prior important level? This rally looks similar to this rally and this rally. Doesn't mean it's just going to fall apart, but it certainly has the chance of doing that. So if you're long energy and you don't want to see it decline to 86, or you're not comfortable with that, start thinking about where your stop goes.